Joining us, Tobias Levkovich, Citi U.S. equity strategist. He sees the S&P at 500 ending 2019 at 3,100 with earnings growth of about 6.2%. Are you still at that view?
Yep.
Why?
We actually introduced this back in September, so it's not like we're doing this in December. But you did have a little bit of sell-off for the last But that's fine. We kind of anticipated something was going to happen back then. In September, our primary sentiment metric, for example, was sending us a 70% signal of a weakening market. Now it's a 90% probability of a higher market 12 months from now. So that's a pretty significant change because of what we've seen in the sell-off in October, November. The key issue was that earnings expectations for 2019 were too high. So consensus estimates back in September, we're talking a 12% earnings growth. Now it's just under 9%, probably heading closer to our 6%, maybe it'll be at 7%. But stocks don't generally go up when you're missing estimates. They can have traction if you've got meet or beat. And you just got to get those numbers down. And it was kind of almost ridiculous, those 12% numbers. I hate being that hard. But in the first half of this year, pre-tax earnings, okay? So we're looking before we get the benefit of the tax cuts. What were the operational direction of the businesses? Back then, just remember the environment you were in the first half. We called it global synchronized recovery, that kind of stuff. I call it the beautiful day, the sun is shining, the birds are singing, the children are playing. In the background, you can almost hear the ice cream truck music playing. Right? That was that wonderfully beautiful scenario, and you got 12% pre-tax earnings growth. Why were we going to get 12% growth in 2019 in an environment where the dollar is stronger, interest rates are higher, there's problems in emerging markets, Europe's sluggish? It just didn't make sense. Yet those numbers are out there, and that was the risk. And now that they've come in, that looks okay. The earnings recession fears, and if we don't get a full recession, come from things like wage pressures. And actually, we run this lead margin indicator. We look at the difference between what's happening in wage growth, and we agree that it's going to get more extreme, if you like, from where we are currently. We think 3.5% is probably where wage growth is going to be. But pricing power is also there. Companies intend to raise prices. Companies have started to do so. So they're not going to give it up just because. Companies really, really don't like doing that. So I don't think the margin pressures are going to be there. We can spend a lot of time discussing this, and we have since 2011.